Hello, this week I'm taking a closer look at Credit Suisse after it was rescued in a deal with UBS. Over the weekend, it was announced that UBS is paying 3 billion Swiss francs or £2.6 billion to acquire the embattled rival Credit Suisse, taking on losses of up to $5.4 billion. The Swiss regulator FINMA decided that one type of Credit Suisse's bonds, known as Additional Tier 1 bonds or CoCo bonds, worth $17 billion, will be marked down to zero. The Swiss National Bank is providing 100 billion Swiss francs for the merged entity as part of a deal to help offset the risk of financial contagion. UBS's CEO Ralph Hamers says the transaction is financially attractive for UBS shareholders, and there are plans to wind down Credit Suisse's investment bank. Shares in Credit Suisse fell by 60% at one stage on Monday, reflecting the cut price UBS paid in the deal. Shares in UBS initially fell on Monday, but recouped earlier losses to close in the green. So why has Credit Suisse found itself in this tough position? Well, the Swiss lender has been embroiled in scandal after scandal in recent years, including links to the collapse of Greensill Capital and hedge fund Archegos Capital. Credit Suisse reported a mega £6.6 billion net loss for 2022 in February after months of uncertainty, client outflows and a declining share price. On top of that, last week the lender said it found material weakness in its financial statements, and its biggest shareholder, the Saudi National Bank, said it was not willing to provide further financial support. The Swiss National Bank was forced to step in to provide liquidity to support Credit Suisse last week. CS is a 167-year-old institution and has been instrumental to the growth of the Swiss economy. The turmoil came amid an already strained period for the banking sector, following the collapse of Silicon Valley Bank on the 10th of March. The deal between UBS and Credit Suisse did little on Monday to assuage the slump in sentiment towards financials, with banks suffering across Europe. However, sentiment picked up on Tuesday with a relief rally and improved risk appetite as investors digested the deal. So what's next? Well, up to a third of the 120,000 jobs at the combined UBS Credit Suisse group could be let go. According to the Financial Times, tens of thousands of staff could be cut, with Credit Suisse employees most at risk. A major restructuring and cost-cutting program was already underway before the rescue deal, with 9,000 job cuts planned at Credit Suisse, as well as a major scale-back of its investment bank. The marriage between the two Swiss lenders leaves much uncertainty and nervousness among employees, who are unsure whether they'll be let go. Southeast Asia could be the region most at risk to job cuts, given that it reportedly has the biggest overlap in terms of investment banking and wealth management teams. Meanwhile, legal action is being considered against Credit Suisse after its AT1 bonds were written down. According to Reuters, PIMCO lost about $340 million on its Credit Suisse CoCo bonds, and one analyst at Goldman Sachs there's concern about permanent destruction in the market. Bondholders typically rank above shareholders in the repayment pecking order when a company fails. Yet in Credit Suisse's case, its convertible bondholders saw their investments entirely wiped out. Much uncertainty remains about the future, with potential for litigation, job cuts, restructuring, and even outflows. The first step is to shore up confidence and convince shareholders of the potential synergies from the combined group. Let's take a look now at the chart of Credit Suisse, because despite strength across equities on Tuesday, Credit Suisse remains under pressure. The stock is down over 70% year to date and is down nearly 90% over a one-year period. Switching to UBS's chart, meanwhile, it's trading less than 1% higher year to date and is up around 3% over a one-year period. There's a mixed view on UBS from the analyst community, with 10 buy recommendations, 6 holds and 3 sells on the stock, with an average price target of 21.9 Swiss francs, up 21% from the current share price, although we could see significant revisions from the analysts in the days ahead. Thanks so much for watching, and I'll be back here at the same time next week with another stock to watch.